All right, so welcome to webinar 19, How to Tame Your Investing Fears. Patrick Gall, who usually joins me on these webinars, is on a much-deserved wedding anniversary vacation. So we have Ross Chwanski, another licensed advisor with our firm. He is joining us today, so he's going to be helping out.
Good morning. Just again, big shoes to fill with Patrick out today. But again, any issues getting on board for the webinar, go ahead and email us at info@oceansideadvisors.com. And then just a reminder, any questions, submit those at the bottom of your screen, and we'll get to those at the end.
Perfect. Thanks, Ross. All right, so let me get this started here. All right, so we hope everyone's having a nice summer. I know that the Kroll family, we've been able to escape the Charleston heat. We took a trip up to Minnesota to see family, which was really nice, and I was able to go on a trip to see my old Ohio State friends. So it's been a nice summer, and we hope that the past few months have been nice for you as well. And now we're definitely gearing up here for the fall season. This is where we get into a lot of the heavy tax planning and so some really important financial planning decisions to be made. So we're looking forward to meeting and seeing many of you in the coming months here. So today, how to tame your investing fears. I'm going to start with our disclaimer. Through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. Information provided is for informational purposes only and does not constitute financial, tax, or legal advice. Of course, we give people this advice all the time, but we need to get to know you a little bit better before we can do so. All right, so to kick it off, I thought it made a lot of sense to start with a recent email I received. It's probably 2 months ago now. So probably 2 months ago. This email is not from a client, but I received it from somebody that watches our little Monday videos that tunes into occasional webinars. And I thought it was a really good starting point for the purpose of today's conversation. I'm just going to read this to you. So the email says, Johann, I've been watching and reading your educational content for a while now. I appreciate your efforts, especially the webinars. Thank you. Over the past few decades, I've managed to save a decent chunk of money. And 2 years ago, I sold a rental property that was becoming a headache. My net worth is approximately $1.5 million, which is now made up of my primary residence, about $600,000 there, and $900,000 worth of liquid assets. Of my liquid assets, only about $300,000 is invested, leaving approximately $600,000 just sitting in cash. This large amount of cash is bothering me. I know I need to invest to earn a real rate of return, as I understand the inflationary cost of holding cash. However, since 2015, I've been holding way too much cash while waiting for a significant market correction. When COVID hit in 2020, I missed the opportunity and did not invest any cash because I was certain the market had further room to fall. Now I am concerned that the stock market may continue pushing higher while I miss out. What steps do you recommend I take to overcome these fears? All right, so there are so many things to unpack in this email. It's an email like this I'll receive every now and then. but so many people have these concerns. And so it was actually this specific email that made me think of this webinar topic, how to tame your investing fears, right? There's so many little things in this email, and this is really somewhat going to guide the following slides that we go over today. So our goal today is to discuss why we experience fear when investing and some practical steps to overcome it. All right, so the first step is recognizing that fear is normal and it's okay. All right. The second step is going to be to educate yourself with reasonable expectations. All right. And I'll start by saying, like, you want to educate yourself from reliable sources. All right. So that would not include like watching CNBC advertising, trying to figure out why the market's going to crash next, or which stock is going to soar, as they say, soar over the next, couple weeks or months. All right. That's not truly educating yourself with reasonable expectations. The third step is going to be to create and implement a plan and strategy. Because without a plan, okay, if you don't have a plan, you're kind of stuck at the mercy of day-to-day price movements. You're going to become much more emotionally driven, given what the market's doing, if you don't have a plan in place. All right, and then the last step is just keeping proper perspective and understanding that you're going to make mistakes along the way. All right, no one has a crystal ball. So the timing of when you get in or out of markets, like it's never going to be perfect. Mistakes are going to be made, and really you just want to go along with the journey, having a plan in place. All right, so these are the 4 steps we're going to discuss today that can really help if you're dealing with if you're fearful with investing. All right, so first step, recognize that fear is normal and it's okay. All right. We all experience fear when investing. All right. I'd be lying to you if I said like I wake up every day like not concerned ever like what the market's doing. That markets can move fast, as we all saw last year in 2020. Like that fear is very normal. Okay. It's just important to point out a few things. One is, our human brains are very prone to what's called loss aversion. We've discussed this behavioral bias in past webinars, but what loss aversion is, they've actually tried to quantify this, but basically, as humans, losing something is twice as painful as the pleasure experienced from gaining the same thing. Okay, so we put an incredible amount of emphasis and pain when we lose something. Okay. And this can cause investors to sometimes, without a plan, like this can cause people to be overly fearful and risk averse. Okay, so just important to point out that our human brains are very prone to loss aversion. Many of us have felt the pain of losing money in previous market corrections, whether that was back in 1987, the giant 20% drop in one day, whether that's the .com internet crash, the financial crisis, COVID. Like many of the clients we work with have experienced all those. Okay, so you remember what that pain felt like, during those times. Okay, however, it's also important to recognize that waiting for the market to crash, like, so going back to the email, like to be waiting for the market to crash, or you're waiting for the market to decline further before investing, many times it's simply a means of running away from our fears, right? Because we're scared. We don't want to make another mistake. So really that's where fear can play a big role. All right. So the big question, how do I get rid of the fear? Okay. Seth Godin, who is an author, entrepreneur, writes some really nice things. He has a famous set of quotes that maybe some of you have seen these before, but he says this: "Alas, so how do I get rid of fear? This is the wrong question. The only way to get rid of fear is to stop doing the thing that might not work, to stop putting yourself out there, to stop doing work that matters." Okay, so no, the right question is, how do I dance with the fear? And then most importantly, fear is not the enemy. Paralysis is the enemy. Okay, we're all going to experience this fear, fear of, and you could take this quote in a lot of different areas of life, right? Like, unless you totally give up and you do nothing that matters, right? That the first part of his quote, like, you're always going to have fear, right? So it's how you, in his words, dance with it. How do you deal with the fear? And the true enemy is paralysis. It's not doing anything, and that's where investing can become. People can struggle with it, right? All the fears that you saw in the gentleman's email that we started with, it's a very real thing. And he was paralyzed by the fear, right? Paralyzed. He'd experienced crashes before. He thought one was coming. COVID happened. He thought a bigger crash was coming, and he hasn't been invested. So if paralysis is the true enemy, like, the next step you want to take is educating yourself. Okay, and so that's step 2. Educate yourself with reasonable expectations from reliable sources. All right, and so I thought it made sense to kind of go over 4 investing truths. Okay, 4 things that there's tremendous evidence that that backs up. And so I thought and we've touched on some of these in the past in other webinars, but it's important you understand these fundamental 4 things. Number 1, for many investors, not investing is more risky than investing. And we'll go over an example why. Number 2, the market is not like a casino. Number 3, new market highs, okay, when the market's at an all-time high, like, over time have been the norm rather than something to be feared. We'll show a little graph on that. Lastly, the old saying, be greedy when others are fearful. Okay, so we're just going to walk through each of these 4 because this is really important to understand. Okay, so the first, for many investors, not investing is more risky than investing. And for this, Eric Nelson, he has a really nice, it's a fairly short article, but he drives home some really interesting points. It's titled "Learning to Love Volatility." Okay, and he asked this question: which is safer, short-term bond fund or a diversified stock mix? Okay, so on the surface, this seems like a very obvious question, like, which is safer, short-term bond fund or a diversified stock mix? Okay, after all, a bond fund, a short-term bond fund has never lost even 1% in any single month in the last 25 years. Whereas a diversified stock mix has seen 7 episodes of 20% plus losses. And of course, during the financial crisis, dropped nearly 60%. All right, so which is safer? Again, it seems like an obvious answer, but if you dig deeper, and he gives an example, I was thinking about trying to just write this in a PowerPoint, but instead I'm just going to read to you just a hypothetical case. So let's back up. Let's say the year's 1995. All right, so about 25 plus years ago, where we can use these same bullet points of data. The year is 1995, and you have 2 investors, and they each have $1 million, and they both need $50,000 a year plus inflation to live the lifestyle they want to live. Okay. Now, one investor invests 100% in a short-term bond fund. Investor 2 invests 100% in diversified stock mix. Okay, so which is safer? Well, now in that context, I'll tell you the way this plays out. So again, they both have $1 million. They both need $50,000 going up with inflation. So investor number one, who invested 100% in the short-term bond fund, well, they run out of money in the year 2019. They run out of money. Okay. Investor two in diversified stock mix. Again, remember 7 episodes, huge losses. That investor, although their portfolio fluctuated a great deal in the short run during different periods of that 25 years, they end up with over $5 million net of withdrawals. Okay, so knowing those two outcomes, which is safer, a short-term bond fund or a diversified stock mix, right? So a short-term bond fund is indeed safe if the goal is a return of your principal in a few months or a year. However, it's incredibly risky. Owning a short-term bond fund for the majority of your wealth, or cash for that matter, it's incredibly risky if the goal is a premium return on your savings over 15 years. All right. And then just lastly, avoiding losses is not a financial goal. You know, it might be a short-term investment goal, but it's not a financial goal. So just understanding back, point number one, for many investors, not investing is more risky in the end than investing. Point number two, the market is not like a casino. All right, so there's a site, I think it's called Wizard of Odds, ODDS, that it shows you the odds of winning various casino games, right? So in other words, the longer you play, the closer you will become to, you know, these are your odds of winning, right? So I think blackjack is 48.8%. Like roulette might be 48. Craps, I think, is 48.6. I have no idea what 23% is, but I wouldn't want to play that game. So in the long run, the longer that you gamble at these various casino games, like these are your odds of winning. And some people say, oh, you know, investing is like gambling, where I would disagree quite strongly, because the way it works with investing, time becomes your friend. So here is nearly 120 years of rolling periods. The way it works with investing, in any single year, any 1 year, there's about a 73% chance that you will win. Okay, that your account would go higher. If you increase the period to 3 years, okay, so any 3-year period, about 85% of the time you would expect to come out ahead. 5 years, 10 years, 15-year period, you're almost guaranteed to come out ahead investing. So important to make this to make this point that investing is not gambling. So reject that notion anytime you hear that. Number 3, new market highs over time have been the norm rather than something to be feared, right? So back to the email we started with. This gentleman, you know, was well aware that the market was making new highs, and we hear this one a lot. Oh, the market's at all-time highs. Like, this is probably not the greatest time to invest. Well, over time, like, market highs is the norm. Okay, so it's not something that should be feared. What we have here is each of these blue bars, which the pixels aren't fine enough to show how many of these blue bars there are over time. This is since 1957 S&P 500. And this is only through 2019, right? So through 2019, there were 1,084 new highs, new daily highs in the S&P 500. That number would be even higher today, given we've had a number of new highs this year. So now there are going to be periods, right? Like we know markets correct. We know that markets crash from time to time. That's part of investing. So like there will be there are 3 to 5 year periods where there are not market highs, and that again, that's okay if your time frame is long enough. But I think this graph just kind of illustrates there's a lot of market highs, and many times the market continues to make new highs for many years, multiple highs, new years. So another thing to keep in mind to educate yourself. Okay, the flip side of investing at all-time highs, and again, back to the email, right? The market crashed during COVID, right? We have this unprecedented pandemic. I think the market's going to fall further, was the gentleman's email. Okay, so, and this is the old saying, be greedy when others are fearful. So the other side of the coin, when everyone's running for the exits, this is when you just need to put your neck out there, and you might be early, right? You might be early, but in the end, when things look really, really bad, these tend to be great opportunities when they do come. We don't know when they're going to come, but these can be really, really nice opportunities. Okay, so a couple examples that I have here. December 1994, I don't know if you can see the headline here, Mexican government devalues the peso. Market obviously crashes a great deal. 10 years after the crisis, the Mexican index, the MSCI Mexico index, is up 443% from the day of this big headline event. South Korea requests IMF aid, November 1997. 10 years later, they're up 175%. Russia defaults on their debt. This is August 1998. Nearly a 4,000% gain in their market since the Russian default. Argentina defaults December 2001, up over 1,000% in 10 years. Okay, so this is again, and we could, obviously financial crisis, Lehman Brothers goes belly up. There's all kinds of fear on the street, and since the financial crisis, I think the U.S. market, I could have put that in there too. Now that we're 10 years removed from that, I think was up about 250 to 300%. Okay, so understand, like, when markets are crashing, we don't know when that's going to happen. It's another great time to be adding new capital, even if you don't have new capital, to be rebalancing right into more risky assets. So another thing to keep in mind. All right, so those are kind of the 4 truths that I thought, just to provide a fundamental foundation on kind of grasping and dealing with the fear of investing. Okay, but then important point, like once you understand these things, once you understand and you educate yourself on some true data about investing, you really need to create a plan and a strategy to move forward. Okay, because you still need something that's going to keep your emotions in check, something that's going to provide you a framework where if the market's crashing, you're not being reactionary. You're not being reactionary and trying to make changes on the spot, because if you do that, your human behavioral biases will take over, and the research is crystal clear on that. Like, that's not good. So step 3, you really want to create and implement some kind of plans and strategies, and we're going to go over a couple here. Okay, so one option, this isn't my favorite option, but if you are super concerned about investing, one option is to slowly do it, right? So rather than invest a lump sum of the savings you have sitting on the sidelines, you can start investing by dollar cost averaging, right? So stated another way, you could automate like a weekly or a monthly contribution to your accounts. And so this strategy is going to allow you to be investing but psychologically, it kind of helps manage potential regret if you time the market wrong, right? So, of course, a worst case scenario, you invest a lump sum and the market crashes the next day, and then you have all this regret, buyer's remorse, if you will, even though that's not really the same thing. And so like this is an option. Okay, I will say that there's been some nice research done on this. PWL Capital shows that this method is definitely suboptimal. All right, about 2/3 of the time, people would be better off investing a lump sum as compared to dollar cost averaging. So slowly investing. But if this is like maybe the first step to get you investing, this would be a good way to do it. So just slowly start investing by whatever kind of discretionary income you have, just setting a certain schedule, X amount of dollars on the 5th of each month. And regardless of what the market's doing, like that amount is going and being invested in your account. We do this for a lot of our younger clients still working. This is also what your 401k does, by the way, right? So you set, bi-weekly, however often you get paid, you send money to your 401k. This is exactly what that is. Okay, another strategy would be using a bucket approach. So these are like, you kind of create mental buckets in your head. What I mean by that is you might have a speculative bucket, a safe bucket, you can have an income bucket, a longevity bucket. So put it another way, like your safe bucket, maybe you do keep some cash, right? You do put money under the mattress, just to fill that mental bucket for yourself. But then you have some other, maybe your income bucket, you have some safe bonds, maybe some intermediate duration bonds. So at least you're taking a little bit of risk, but your principal is probably pretty safe. And then you can have like a longevity bucket or a retirement bucket, where this is probably where this concept is the most helpful, where just in your head, you know you're not touching your longevity or retirement bucket for 10 to 15 or 20 years. And therefore you can, again, psychologically, you can allow yourself to invest those funds, knowing that if the market crashes, like that's fine, because I'm not touching that money. I don't need that money for many, many years. So you can kind of psychologically justify that fear of investing, knowing that you don't need it in the near term. So that's the bucket approach. Another approach I want to touch on is one we do for a lot of our retiree clients. This is called a guardrail income approach. So this is going to look overwhelming at first on the screen, but it's really not that hard. So we use this system for to give retirees the highest possible monthly income. Okay, so a lot of times when people sit down with us, it's they have a 401k or an IRA, and they don't exactly know, like, how do we turn this into a safe withdrawal rate? Okay, and so this system is designed to give retirees the highest possible monthly income without jeopardizing their portfolios when not if markets decline. So you have a system in place that's going to work whether markets are doing well or they're doing poorly. All right, so I'll just walk you through this really fast. So depending on your age, you're going to have different distribution rates. Okay, so for this particular client, John and Jane Doe, we're using a 5% distribution rate for a portfolio that has about $1.1 million. So we know the distributions coming out of the portfolio will be about $55,000 annually, about $4,500 monthly. All right, so the way the guardrail system works, as long as the portfolio stays between what we call these guardrails, upper and lower guardrail, we continue to distribute this initial withdrawal rate amount. What then happens is when markets crash, not if, but when markets crash, and we have our lower guardrail breached. And I know, I think we went over this in a previous webinar, but when our lower guardrail is breached, in this case, $920,000. So if the portfolio ever falls below $920,000, we're just going to take a temporary pay cut. We're going to reduce income to $4,100. Okay, $4,100 until the market recovers. We'll get back to the initial withdrawal rate. Conversely, you have an upper guardrail, right? Like you've worked hard for your money. If the market's doing well, portfolios are growing, and you breach the upper guardrail, well, then we're going to encourage you to spend more. Go on some more trips. You've worked hard for the money, like enjoy it. Okay, so this approach, again, it allows people to use their hard-earned money, because remember, money is just a tool, right? It's a tool that you want to use to do the things that are important to you in your life. And by having the system, again, breaks, like we're going to reduce income temporarily. The reason we do that is to fight sequence of return risk. All that means is where people get in trouble in retirement is markets go down, they spend the same amount, and then what happens is whenever the market subsequently recovers, they don't have enough in the portfolio to recover with it. All right, so by following a very detailed system, and we could do a whole webinar just on this, but you have to have a very specific asset allocation war chest we call it war chest of cash and bonds, where when markets are crashing, we can live off of the cash and bonds for a while. But what's really nice about this is when markets are crashing, so tying this into the fear, the investing fear, when markets are crashing like they were when COVID was going on, when people called in, okay, it wasn't, the call is not how much money is my portfolio down, how much money have I lost? And instead you're asking, how close am I to the lower guardrail where we might have to take a temporary pay cut in our living? Okay, and so again, psychologically, it's so helpful to see it in that framework, and to have some kind of plan, whether you're using guardrails or buckets or some form of systematic investing or some other strategy that you came up with. Just having a plan and a strategy in place can take your mind off the day-to-day movements of the market. Okay, so kind of to wrap up our webinar today on taming investing fears. Number one, remember the fear of investing is normal and okay. All right, so everyone has it. Don't let it paralyze you. Number two, educate yourself with reasonable expectations from reliable sources. Stocks should appreciate modestly over the next 10 years. Anyone that says market crash is imminent is, people have said that for every day of every year. Like eventually you get a market crash, but if you live with that mindset, you could be doing a lot of damage to your financial plan. Number three, create and implement a plan and strategy. And then lastly, I just want to touch on keeping proper perspective and understand that you will make mistakes along the way. All right, so market, there's good times, there's bad times, and really a lot of this ties into point three, create and implement a plan, because if you have a plan and the market starts crashing, many of those losses are just going to be on paper, right? If you're not capitulating and making behavioral errors, many of those losses are just going to be temporary and on paper. So keep the proper perspective and know that mistakes are going to happen along the way. All right, like no one has a crystal ball. There are going to be times that you invest and the market goes down. Okay, that's going to happen, and that's okay. So just kind of go along with the I think it's much better just to go along with the financial journey and the journey of life and have a plan. I'd encourage you to reach out to someone or other sources to find a means of helping you address any kind of investing fears if you do have them. And of course, we would be happy to help and embrace the journey. So with that, we appreciate you tuning in for the webinar. Ross, do we have any questions on the docket there?
We have two questions that came in.
Okay.
The first one is from Rick, and he asks, how did you respond to the email from the beginning of that webinar?
Oh, fine, Rick. So I responded with very similar to exactly what we went over today, right? So I think really just showing, I responded by just writing back really everything we went over today. So just, here's the thing, like an imminent market crash, like we don't know that with any certainty at all. It's okay to invest at market highs. It's okay to invest at market lows. If you want to just kind of dip your toe in the water, do it in a systematic dollar cost averaging way. So really kind of all the things we went over today was how I responded to that email.
Perfect. And then the second one that came in, more specific, what are the income guardrails based on? That's from Michael.
Oh, cool. Yeah. Yes, I should have maybe clarified that a little more. The way we implement that, it's all based off of Jonathan Guyton's research. Okay, so he wrote a paper in, there's two papers, but I think the first was written in 2004, the second maybe 2006. You could Google it and find it. It's if you just Google Jonathan Guyton's safe withdrawal rates, and he goes into great detail on this rules-based approach, right? So for example, one reason why the 4% rule, right, the so-called 4% rule is criticized so harshly, and rightly so, is a 4% rule. Like, you start withdrawing 4% and you put your head in the sand, regardless of if the market is doing regardless if the market is doing great or poorly, like, you keep withdrawing 4%. And what Jonathan Guyton shows in his research, it's like that can be a really bad idea, because if markets are crashing and you're withdrawing the same amount of money, you can run out of money with the wrong sequence of events. So Guyton puts these rules in place where if your portfolio breaks below a certain level, like, you need to reduce spending to give your portfolio time to recover. And then the upper guardrail, of course, if things are going well, like, increase your withdrawal rate, because you can, right? Like, your life's getting shorter. If your portfolio is getting higher, like, yeah, start spending. But it's yeah. So if anyone wanted to look into that, it's Jonathan Guyton's paper on safe withdrawal rates. And that now, since then, I know I'm kind of rambling a little bit, but since then there have been some things that have fine-tuned, and it's been modified a little bit just to improve the process. But that'd be a great starting point, just to look at his initial guardrail paper.
Perfect. We had a third question pop in here from Bob. He asked, considering the proposed federal tax increases, is this a good time to invest?
Yes, I think it is. Any kind of proposed tax increases are going to be priced into markets rapidly. And yeah, I don't like speculating on what the final legislation is going to look like, but for all the reasons that we went over already, yeah, I mean, if tax rates go up, like, I mean, earning 0% on your money, even if you have to pay a higher tax, it's going to be better than earning zero, not investing. So yeah, I think regardless of what taxes look, well, unless they've made it 100%, but then I think we'd be dealing with some bigger problems. But yeah, so I think higher taxes, you still want to invest.
Good.
Cool.
Okay. Thank you, Bob, Michael, and Rick for the questions there.
Yeah, thank you for everyone joining today, and certainly reach out to us if we can help with anything. And yeah, we hope everyone enjoys a nice long Labor Day weekend. I've got a 10-year anniversary, so that's kind of fun. But and for many of you, we will see you in the fall reviews here coming up in the next month or two. So we look forward to it. Thank you.